$200 billion wiped out from the cryptocurrency global market cap in just shy of 24 hours. Many of you are probably wondering what on earth is currently happening across the crypto space, particularly when majority of the stock indices and equities at the moment are performing incredibly well. We're touching on what's been happening recently to drive a lot of this negative pressure throughout crypto, and also why we're seeing equities rise all of a sudden. Let's start by looking at the fear and greed index for cryptocurrencies. So as we can see at the moment, we have shot back down from a fear of 30 yesterday down to 22. Again, not as low as we'd previously seen, but there has been an incredible amount of pressure with FTX causing or potentially filing for bankruptcy effective immediately. Withdrawals are being paused again, and it seems to be that every 6 to 12 months now, we are having some kind of major centralized exchange backlash or exposure from poor practice and mismanagement, which is leaving customers unwhole, and it is a complete and utter misery for the majority of people involved. Firstly, before I delve into what the hell actually happened yesterday, I wanted to quickly talk about this. Of course, interest rates and macroeconomics have been main focus for the last 6 months or so, particularly if you check out my previous videos talking about where I expect the bottom of the markets to actually be and a good time to potentially look to build even larger positions. Although now, personally for me, does appear to be a very good time due to what appears to be a sort of unnatural shock to the market, which we'll look at in a second. But US stocks roared ahead on Thursday today in their strongest day in more than 2.5 years, with investors emboldened by inflation data that showed decelerating increases in consumer prices, and has set the stage for a slower pace of interest rate rises by the Federal Reserve. Now, this doesn't mean that they might not necessarily become dovish. They may still remain hawkish, but to a lesser degree we'd seen previously. And it goes hand in hand with what I talk about in the other video. I'll try and leave a card and a link in the description about why I potentially believe the terminal interest rate will be one of the main driving factors for timing the bottom of this market. What we can see here is Wall Street's benchmark S&P 500 index gained 5.5%, while the tech-heavy NASDAQ composite closed 7.4% higher, and that is off the back of that CPI figure for October being reported at 7.7%, a sharp drop from the annual rate of 8.2% in September. And even the month over month, the banks are pricing in between, on average, the estimates from analysts 0.5 to 0.7% month over month, and it came in at just 0.4%, so severely under analyst expectations, which is of course driving the equities markets to surge forward at the moment. Unfortunately, the same can't be said just yet for cryptocurrency. While there has been a slight recovery, it is of course being plagued by the latest contagion, which is FTX. There's a great thread here written by a guy called 𝗟𝗜𝗡𝗏𝗏, and I wanted to talk through it. So effectively, FTX played out in a similar manner, and this is why we're seeing what we are seeing. You have 100 customers who are long Bitcoin on margin. They each have one Bitcoin in their account and owe you $10,000. You have 100 customer BS who are short Bitcoin on margin, called customer B, sorry. They each have $20,000 in their account and you owe 0.5 Bitcoin. You then loan 50 of customer A's Bitcoin to customer B and 1 million of customer B's dollars to customer A's. You keep the other 50 Bitcoins and $1 million as collateral. Your accounts show that you owe clients 100 Bitcoin and $2 million, and that they owe you back only 50 Bitcoins and $1 million, and you have 50 Bitcoins and $1 million on hand, so everything balances. You have one customer C who says, "Hi, I would like to borrow 50 of those Bitcoins and $1 million. I will secure that loan with 150,000 FTT, which was FTX's native token themselves, each of which is worth $20. You say, sure, sounds good, hand over all of your collateral. You now have 150,000 of that FTT token worth $3 million as collateral and no Bitcoins or dollars. Your accounts show that you owe clients 100 Bitcoin and 2 million and 150,000 FTT, and they owe you back 100 Bitcoins and $2 million. You have 150,000 FTT of collateral, so everything balances. Now, of course, the problem being is that you've effectively, you're collateralizing assets in your own personal token that is being built by your platform. If you then have liquidity issues, you have major implications for your balance sheets. And that is currently what is happening right now for FTX itself as a platform. Their balance sheets do not stack whatsoever. And of course, they are being sort of spoken about in the light of that they've effectively defrauded their customers. You can see here from this different thread, the Wall Street Journal said FTX had $16 billion in customer assets. And they also then gave $10 billion of that to Alameda, who was a sister company, who blew it all. So they were effectively gambling with customers' deposits themselves. This is a far cry from what the industry should be doing. For example, we know that Binance effectively keeps reserves 1-to-1 of customer assets, which they should do, and those are kept in cold storage. They're not playing with people's funds, of course, which what FTX were doing. You can see here a decision that Mr. Bankrupt described as a poor judgment call. All in all, FTX had $16 billion in customer assets, according to the person. So FTX lent out more than half of its customer funds to its sister company, Alameda. Absolutely crazy, and this is obviously leading to where we are right now. Now, in terms of where we go from here, there were talks that Binance were looking to potentially do a buyout to solve the liquidity crisis that FTX are currently experiencing and try and make customers whole and take a small hit on it themselves. They looked at this balance sheet situation and immediately pulled the plug on it. It is clearly in a much worse state than what is currently being presented to everyone on the likes of social media. We can see here from WatchGuru, FTX reaches an agreement with Tron apparently though, allowing TRX, BTT, JST, SUN and HT holders to swap assets from FTX 1-to-1 to external wallets. So effectively they are trying to provide liquidity here from other projects in favor of those providing liquidity, because those tokens aren't worth anywhere near as much as what the FTX token is or was. I'm not even sure at this point what the FTX token is worth. It's probably worthless, a bit like Luna. And of course, these contagions spread out further. FTX US is saying trading may be halted as well in the coming days. And this is just after FTX US, or them saying that effectively they are an independent company from FTX International and their funds are secure. They're now turning around and saying that potentially positions should be closed. They're warning users trading may be halted on FTX US in a few days. Please close down any positions you want to close down. Withdrawals are and will remain open. We will give updates as we have them. It's enough to be said. I've mentioned it many times on this channel before, and many other influencers or whatever you want to call us from across the Hedera space particularly have spoken about not your keys, not your crypto. It's really important to have non-custodial wallets where you have the private keys and the seed phrases so that you don't effectively end up victim to something like this. It's completely out of your control. You would never have known that FTX behind the scenes were effectively gambling customers' money without any of your intervention whatsoever. And of course, even some of the bigger exchanges, this was the number 2 ranked exchange in the globe, potentially even Binance, have some different mechanisms behind the scenes that maybe not everyone would be too happy with if you knew what they were doing. Of course, that's just me making up hypothetical scenarios, but why even take the risk? Get some of those custodial wallets for yourselves, transfer that capital off of exchanges, get them on hardware wallets, hot wallets, whatever it may be. You are much more secure in something which effectively cannot be played with, and someone else is not taking control of your capital or funds. Seriously important stuff. And obviously I feel quite bad for anyone that actually used the FTX platform. Thankfully, I'm not one of those. Something else interesting to come out the back of this as well is that Solana may be in for a huge reckoning. The market cap has fallen absolutely dramatically over the past 24 hours as well. And one of the main reasons is covered in this thread by 𝗟𝗜𝗡𝗅. So one of the most challenging and unspoken issues facing the Solana ecosystem are the wrapped Solet tokens, namely SOBTC, which is used widely across lending and AMM platforms. The problem being these tokens are issued by FTX or Alameda, the sister company, no one actually knows. And these tokens were launched very early in the Solana DeFi cycle to help generate liquidity in the space. Ironically, this goes in tandem with many of our previous videos where I've spoken about how Solana effectively rushed into the DeFi scene to capture a lot of that sort of market capital that was flowing around. And that's obviously one of the reasons the project did so well. There was a lot of sort of degenerate behavior happening within decentralized finance, calling for lower fees as opposed to Ethereum. And Solana really played their cards quite well and took advantage of that. But they're reaping what they sowed effectively with the development cycles. Regardless, the liquidity in the space is supposed to be backed 1-to-1 by Bitcoin or Ethereum. So you've got SOBTC or Ethereum. But unlike wrapped Bitcoin, which helped to start, there was no formal process and no one actually knows if FTX still has the underlying assets. So if we look at that previous example where effectively, someone could come up and say, can I borrow a bunch of this Bitcoin and I'll give you a bunch of these FTT tokens back? And they were just going, yeah, sure, we'll take those FTT tokens. Well, some of those Bitcoins they've effectively swapped for FTT might have been backing some of these SOBTC tokens, which are providing liquidity on the Solana chain and the Solana DeFi ecosystem. Very problematic because practically all of the major DeFi platforms have SOBTC assets as collateral, since it has been long accepted as the de facto Bitcoin standard in the Solana space. So if BTC SO or SOBTC turns out to have absolutely no value because there's nothing backing it, then it could worsen the contagion along more dimensions, namely into the Solana DeFi ecosystem and anything as well built off the back of that with its liquidity pools. It is one thing for prices to fall and have liquidations be called, which is normally a normal function of DeFi markets. It's another thing to have the underlying assets be completely invalid, which is not supposed to happen under any circumstances. It's obviously important for Solana and the Solana Foundation to help push FTX and Alameda for more clarity on the situation, and for the Oracle providers like Python Network and Switchboard to share the details on how they plan to handle these assets. If it turns out these assets are no longer backed, they need to be marked down, take a loss as an ecosystem, and remove the asset completely from the space. Not pretty, but better to happen now rather than later. So you can see here there is clearly another massive risk contagion for the Solana ecosystem, and this could be one of the final nails in the coffin actually, if it does turn out that majority of the DeFi-backed liquidity across Solana isn't actually backed whatsoever, and it's all just numbers on a screen, so to speak. Bad news. Anyway, jumping across to some good stuff in terms of Hbar and Hedera. Of course, things are continuing to build and ramp up over time. I am looking forward to putting out a single-sided staking source swap video when that does go live. But until then, let's cover some of this news. So the Hedera mainnet has actually been on fire for the last couple of hours. Yesterday, I tweeted out, in 1 hour period of when I had a look, 2.27 million transactions were processed, an average transactions per second processed of 632, with nearly 1200 max TPS. The topic ID submitting the main bulk of these consensus transactions since 8 AM GMT yesterday was the AD topic ID 0.01042689. Any of you can check that on Dragonglass or the other explorers. And of course, this does appear to be the Avery Dennison one where I did some detective digging previously. What we can see here is an absolute massive spike where I took a screenshot from Metrica of effectively this AD topic being switched back on. In fact, Christian Hasker also turned around and said, don't be surprised if this turns back off. That's why the transactions have fallen back down. Effectively, Avery Dennison are doing some very final sort of tests and bursts of their platform to ensure all the transactions are being logged smoothly via the consensus service. And very soon it will be flipped on and left on permanently. So we will effectively be seeing, these hundreds or if not thousands of transactions per second from one single use case being on repeat 24 hours a day, 365 days a year. So some serious progress there. In fact, if we look over to the Hbar Foundation's Twitter page, we can see them tweeting out 10 hours, 24 million transactions on just one live enterprise use case testing, and mainnet didn't even break a sweat. And of course, they're not alluding to who it was, but of course, many of us pretty much know it is definitely Avery Dennison with that Atma.io platform. In fact, if we jump over to the Hedera Metrica overview section, we can see here was that total spike. It was nearly 10 hours in the end where we averaged around 51.6 transactions per second, nearly 1,500 on the max TPS, 31.22 million transactions over the weekly period, with obviously 24 million of those coming from that 10-hour stint of where the Avery Dennison ad topic was online submitting those consensus calls. And we can see that again here if we scroll down into the HCS summary, 23,585,000 submitted messages from one single use case. Picture this when we've got more of these severe use cases going on live. We've got the Coupon Bureau, we've got AAA games being built. There are plenty of other major use cases that are being scaled on Hedera right now. This is the first of many, and we'll be enjoying thousands of TPS to come into the future. And of course, that all wraps up to secure the network in terms of things like staking rewards as well. I found this really cool website which works out the average weekly transactions per second. The three red exclamation marks are due to misreporting in their information. But we can see Hedera is now shot up on the weekly to the third highest transaction per second processing, just behind Stellar. I'm going to ignore the red ones as I mentioned. In fact, if we just looked at the stint the average transactions per second was in the hundreds. I think it was somewhere around 600 average transactions per second for that 10-hour stint that they were running that test for. So there is a sheer amount of progress happening at the moment, and I'm very excited for it. Jumping across, I wanted to play this video. It was also retweeted by Mason. It's something from Lehman, and currently I think portrays what's happening in the markets quite well at the moment. I'll play this quickly for you guys.
Typically, the history of any kind of market is that you have this enormous springing up of thousands and thousands of companies, and then you have a crash, and then you get down to 3 or 4 whatever big companies that continue on there. And that's the way every revolution tends to happen. I'm sure we'll see the same pattern here.
And this was from him quite a few years ago. And as Mason says here, watch the dominoes fall while Hedera stands tall. And it appears to be happening at the moment. Obviously, tons of different liquidations and capital being pulled from the markets at the moment. Hedera does seem to be holding up fairly well. Of course, it's taken a bit of a beating in, along with the remainder of the altcoins across the space. However, I still believe in what they're doing for the future. And we've also gained some market cap places along the way. Anyway, hopefully you guys enjoyed this video. This wraps this one up. I will be posting some more videos regularly. Like I said, I'm waiting for some key developments to happen across the Hedera space. There'll be some more tutorials coming out. I am still very active as well over on Twitter, so make sure you guys are following me over there. Make sure you're subscribed on here and have the notification bell on to be notified of my future uploads. Until then, I'll catch you soon. Cheers.